HALT everything. Small silver investors need to watch this now. Last night, while global markets slept, silver did something it hasn't done in over a decade. It surged toward a number that makes central banks nervous. And then, without warning, it was stopped. Not by sellers, not by profit-taking, by something else entirely. Two signals appeared at the exact same moment. One said, sell. The other said, there's no metal left. That contradiction is not a glitch. It's a warning. And what happens next could either devastate unprepared investors or trigger the largest wealth transfer this generation has ever witnessed. Welcome to Hidden Currency. Now, if you've made it this far in life, if you've built something with your own hands, navigated markets, weathered storms, then you already understand. Real insights don't come from noise. They come from patience. So here's a small request from one serious mind to another. If you find value in what unfolds today, take a moment. Hit that subscribe button. Not for us, but so you never miss what matters. And before we begin, drop a comment below. Tell us, where in the world are you watching from? New York, London, Karachi, Dubai, or somewhere unexpected? Let's see how far this conversation reaches. It was 2:47 in the morning. Most investors were asleep. Trading floors in New York had gone quiet. London was still hours away from opening. And yet, something was happening in the silver market, something that hadn't happened in years. The price was moving, not slowly, not gently. It was charging forward toward a number that every serious investor had been watching, the $100 mark. Now, to the average person, a round number means nothing. It is just digits on a screen. But to those who understand how markets truly work, that number was not just a price. It was a line in the sand, a boundary, a point where comfortable positions turn into emergency decisions. And silver was racing toward it. Then something strange happened. At 3:15 in the morning, when liquidity was thin, when most traders were nowhere near their screens, a wave of selling hit the market. It was fast. It was aggressive. It was precise. Within minutes, silver was pushed back, away from the danger zone, away from that critical number. To an untrained eye, this looked like normal profit-taking. Investors had made gains. They decided to sell. Price came down. Simple. But there was a problem with that explanation. A big problem. Because at the exact same moment, while paper contracts were being dumped, something else was happening in a different part of the market. The cost to borrow physical silver was spiking. This is where the story becomes important. In commodity markets, there is something called a lease rate. It is the cost someone pays to borrow actual metal. Real silver, physical bars that sit in vaults. In normal times, when supply is healthy, when metal is easy to find, this cost stays low, barely noticeable, background noise. But when physical metal becomes tight, when there is not enough to go around, this cost rises, sometimes sharply. And on that night, while paper prices were falling, lease rates were jumping. Two signals appearing at the exact same moment, pointing in opposite directions. One said, there is too much silver, sell. The other said, there is not enough silver, pay more to borrow it. This is not normal market behavior. This is a contradiction. And contradictions in markets are never accidents. They are messages. Messages that most investors never learn to read. Consider what this means. If silver was truly weak, if there was genuinely too much supply, then both signals should agree. Paper prices would fall and borrowing costs would stay calm. That would be logical. That would be consistent. But that is not what happened. What happened instead suggests something far more significant. It suggests that the paper market and the physical market are telling two different stories. The paper market, where contracts are traded, where prices are set by algorithms and large institutions, was saying one thing. The physical market, where real metal changes hands, where actual silver must be found and delivered, was saying something completely different. And here's the question that serious investors must ask. When two markets disagree, which one is telling the truth? The one that can create unlimited contracts on a screen, or the one that requires actual metal to exist? This is the difference between a free market and a managed one. In a free market, price reflects reality. Supply and demand meet honestly. Buyers and sellers negotiate openly. In a managed market, price can be influenced, pushed in certain directions, held below certain levels, at least for a while. But managed markets have a weakness. They work perfectly until someone asks for the real thing, until someone says, I do not want a contract, I do not want a promise, I want the metal. And when enough people say that, at the same time, the management breaks down. What happened that night at 2:47 in the morning was not a random price movement. It was a glimpse behind the curtain, a signal that the system is under pressure. that the gap between paper and physical is growing wider, and that somewhere in the machinery of this market, gears are starting to grind. The question now is simple. Who is applying that pressure? And why do they need silver to stay below that line? There is a question that nobody in finance likes to answer, a question so uncomfortable that even experienced analysts avoid it. The question is this: if silver is just another commodity, why does it behave like a secret? Consider gold for a moment. Gold moves, it rises, it falls, but it moves openly. Central banks discuss it. Governments report their holdings. Analysts debate its value on television. Gold has permission to exist in the spotlight. Silver does not. Silver sits in a strange place. It is too important to ignore and too dangerous to discuss. And the reason lies in something most investors have never examined: concentration. In a healthy market, many players participate. Buyers and sellers come from everywhere, different countries, different motivations, different time horizons. This diversity creates balance. No single player can control direction. No single institution can dictate price. The market breathes freely. But the silver market does not breathe freely. For years, a small group of large institutions has held short positions in silver. Not ordinary positions. Positions so large, so disproportionate, that they dwarf what exists in almost any other commodity market. Now, what does it mean to hold a short position? It means betting that the price will fall. It means profiting when silver goes down. And when a small group holds enormous short positions, they do not just bet against silver, they have a reason to push it down. A financial reason, a structural reason, perhaps other reasons entirely. This is where the story enters territory that makes people uncomfortable. Because silver is not just a shiny metal that people collect for hobby. Silver is not just an investment that traders buy and sell for profit. Silver is something else, something strategic. Look around any modern factory. Silver is there, inside electronics, inside medical devices, inside solar panels, inside high-performance systems that most people never see. Silver conducts electricity better than almost any material on Earth. It resists corrosion. It performs under extreme conditions. And here is the critical part. There is no substitute. Engineers have tried for decades. They have tested alternatives. Cheaper metals, synthetic compounds. Nothing works the same way. When performance matters, when failure is not an option, silver is chosen every single time. Now, consider something deeper, something that rarely appears in financial news: defense systems, aerospace technology, communication equipment used in environments where reliability means survival. These systems do not select materials based on cost. They select based on performance. And silver appears in places that the average investor never hears about. This creates an interesting situation. If silver is critical to industry, if silver is essential to national security, if silver cannot be replaced, then certain players might prefer that its price stays calm, predictable, contained. A silver price that explodes upward creates problems. It disrupts supply chains. It increases costs for manufacturers. It draws attention to a metal that some would prefer stays in the shadows. And this is where concentration becomes a tool. If a small group holds massive short positions, they can absorb buying pressure. They can sell into rallies. They can push price back down whenever it approaches uncomfortable levels. Not forever, but long enough to accumulate physical metal quietly, long enough to secure supply before prices escape, long enough to manage the situation until management is no longer possible. This is not conspiracy. This is incentive. And incentives shape markets more than charts ever will. The average investor watches price. They see green candles and feel confident. They see red candles and feel fear. But they never ask, who is on the other side of the trade? Who benefits when silver falls? Who has the capital to absorb unlimited selling? Who has the motive to keep this metal quiet? These questions do not appear on financial television. They do not trend on social media. They exist in the space between what markets show and what markets hide. The concentration in silver short positions is not a rumor. It is documented. It is reported. It is visible to anyone who looks. And yet, it continues, year after year, exposed but unchanged. That persistence tells a story by itself. A story about who controls price channels. A story about why silver behaves differently than other metals. And a story about what might happen when control finally slips. Because concentration works until it doesn't. And when it breaks fast. Every system in the world runs on something invisible. Not money, not contracts, not laws. Trust. Trust that promises will be kept. Trust that words mean something. Trust that when someone says your silver is in the vault, it actually exists. For decades, this trust held firm. Investors bought paper contracts. They never asked for delivery. They trusted the system. They assumed the metal was there. somewhere, in some vault, guarded by someone, verified by some process, and life continued. But trust is not permanent. Trust can crack, trust can erode, and once trust breaks, it does not repair easily. Something is happening now that has not happened in years. Investors are changing their behavior, quietly, without announcements, without headlines. They are doing something unusual. They are asking for the metal. In futures markets, most contracts never result in delivery. They are closed out, rolled over, cash settled. That is normal. That is how the system was designed. But recently, delivery requests have increased, not slightly, noticeably, even in months when delivery is historically quiet. This is not random, this is behavior. And behavior, especially when billions of dollars are involved, tells a story. When sophisticated investors start demanding physical metal, they are sending a message. They are saying paper is no longer enough. Promises are no longer sufficient. We want the real thing, in our hands, in our vaults, under our control. And this creates a problem, a very specific problem, because the system was never designed for everyone to ask at once. There's an old saying among traders, paper is patient, metal is not. For years, this difference meant nothing. Paper contracts settled smoothly. Promises were kept. The system worked. But something has changed. And the change is not happening on screens. It is happening in vaults, in warehouses, in shipping containers moving silently across oceans. Follow the metal, not the price. The metal. Because price can be managed. Price can be painted. Price can say whatever those in control want it to say. But metal? Metal cannot lie. Metal goes where value is recognized. And right now, metal is moving in one direction, east. Consider two cities, New York and Shanghai. In New York, the paper price says silver is worth a certain number. In Shanghai, buyers are paying more, not a little more. Significantly more, $5 per ounce above paper price, sometimes higher. This gap has a name. It is called a premium. And premiums reveal something that paper markets try to hide. Real demand. When someone pays above the official price, they are making a statement. They are saying, I do not trust the paper number. I want the real thing, and I'm willing to pay extra to get it. When this happens once, it is an anomaly. When this happens for weeks, it is a pattern. When this happens for months, it is a transfer. Here is how the transfer works, and it is so simple that most investors miss it entirely. Step 1. Paper price gets pushed down in Western markets. Selling pressure appears. Headlines declare weakness. Retail investors panic. Step 2. Someone with deep pockets buys that discounted paper. They do not sell it back. They request delivery. Actual metal. Physical bars. Step 3. That metal gets shipped, loaded onto planes, placed in containers, sent to vaults in Dubai, in Singapore, and Shanghai. Step 4. The metal arrives in the East. It is sold at the higher premium. Profit is captured, and the metal stays there. This is not speculation. This is arbitrage. Pure economics. Buy low in one market, sell high in another, capture the difference. Repeat. But here is what makes this dangerous. The metal that moves east does not come back. It does not get flipped next month. It does not return when prices rise. It sits in vaults, owned by hands that do not trade on margin. Held by families that measure wealth in generations. Controlled by sovereign funds that think in decades, every single time. Western paper markets smash the price down. They create an opportunity for Eastern buyers to accumulate more metal at a discount. The harder they push price down, the faster the metal drains away. This is the great irony. The weapon being used to suppress price is accelerating the physical shortage. Every attack on paper strengthens physical hands. Every shakeout of Western investors fills Eastern vaults, and the evidence is visible. Not in price charts, in lease rates. Lease rates are the cost to borrow physical metal. When metal is abundant, borrowing is cheap. When metal is scarce, borrowing becomes expensive. And lately, lease rates have been spiking, not randomly, at specific moments, exactly when paper selling appears. Think about what this reveals. If the selling pressure was real, if there was genuinely too much silver, borrowing costs would stay flat. Supply would be comfortable. Metal would be easy to find. But the opposite is happening. Paper says, sell. Lease rates say, there is not enough metal. These two signals cannot both be true. One is reality, one is theater, and the lease rate, backed by actual borrowing, actual metal changing hands, is telling the truth. The physical market is tightening, week by week, month by month. While paper games continue on screens, the foundation underneath is shifting. Metal is leaving, not temporarily, permanently. And here is what most investors fail to understand. This drain does not reverse easily. Once metal moves into strong hands, hands that do not sell at the first rally, hands that do not need liquidity, hands that hold for strategic reasons, that metal is gone from the trading ecosystem. It no longer provides supply. It no longer calms shortages. It simply waits. The visible inventory shrinks. The available float decreases, and the system moves closer to a moment it cannot manage. Consider a simple truth. For every ounce of physical silver that exists, there are multiple paper claims, multiple contracts, multiple promises, all pointing at the same metal. In normal times, this works perfectly, because most people never ask. They hold paper. They trade paper. They trust that paper represents something real. But what happens when too many people ask simultaneously? What happens when delivery requests exceed what the system can actually provide? There is a term for this, a term that makes bankers nervous. Failure to deliver. It sounds technical. It sounds boring. But it is neither. A failure to deliver is the moment when paper and reality collide. The moment when someone says, "Give me my silver," and the other side says, "We cannot." That single moment changes everything. Because a failure to deliver is not just one broken contract. It is proof that promises were empty, proof that metal was claimed but never existed. And once that proof becomes public, trust does not erode. It collapses instantly. Every other investor holding paper suddenly asks the same question. Is my position real? Is my metal actually there? Or am I holding a promise backed by nothing? And when that question spreads, the system faces a stampede. Not a correction, not a pullback, a stampede. Everyone rushing for the exit at once, everyone demanding the same metal that does not exist in sufficient quantity. This is why certain signals matter now, signals that most investors ignore, signals that separate those who see clearly from those who learn too late. There are 3 indicators, 3 simple questions that every serious investor must monitor. First, what is the relationship between spot price and futures price? If futures trade above spot, the market is comfortable. If spot trades above futures, urgency is building. This is called backwardation, and backwardation in precious metals is a warning light. Second, what are lease rates doing? If borrowing costs stay low, physical supply is adequate. If lease rates spike, metal is tight, and when spikes happen during paper sell-offs, the tightness is severe. Third, what are physical premiums doing in major hubs? If premiums collapse with price, weakness is real. If premiums stay elevated while paper falls, the paper move is noise. The physical reality is different. Right now, all 3 indicators point the same direction. Backwardation has appeared. Lease rates have spiked. Eastern premiums remain elevated. The system is under stress, not visible stress, not headline stress. The kind of stress that builds silently until it cannot be contained. And here is what separates survivors from victims. Survivors do not wait for the break. They position before it happens. They accumulate while metal is available. They remove counterparty risk while removal is still possible. Victims wait, they watch, they assume the system will hold, and when it doesn't, they discover that their paper was never worth anything at all. The window to act is still open, but windows do not stay open forever, and this one is closing, not with a warning, not with an announcement, just closing. Those who understand will position accordingly. Those who don't will learn why silver has always been called the metal of hidden truth.